China's banking sector is facing a major crisis that may have significant impact on the global economy.
People in China's financial system are rattled.
China's under-pressure economy is displaying more signs of stress on multiple fronts.
Chinese authorities have launched an investigation into one of the country's largest shadow banks, Zhongzhi.
China's $3 trillion shadow banking empire just cracked wide open, and Beijing scrambling to contain the fallout. In November 2023, wealth management giant Zhongzhi Enterprise Group admitted it was severely insolvent with liabilities of 460 billion yuan against assets worth just 200 billion yuan. That's a $36 billion black hole that materialized overnight. But Zhongzhi wasn't some rogue operator. It was the poster child of China's shadow banking sector, managing over $140 billion in assets through a sprawling network of trust companies and wealth management firms. When its founder died and management ran wild, the entire structure collapsed like a house of cards built on quicksand. What happens when the world's second largest economy discovers that 40 to 60% of its GDP depends on financial institutions operating in the shadows? How deep does this contagion spread when shadow banks hold $3 trillion in assets tied to China's imploding property sector? And why are Chinese authorities moving with unprecedented speed to bury this crisis before it metastasizes? This isn't just another corporate bankruptcy, it's the largest shadow banking collapse in Chinese history, dwarfing anything the West experienced during 2008. Zhongzhi's $60 billion shortfall represents the tip of an iceberg that could sink China's entire financial system. The numbers are staggering. China's shadow banking sector exploded from virtually nothing in 2010 to $92 trillion globally by 2015, with China accounting for the fastest growth. These aren't traditional banks. They're trust companies, wealth managers, and asset management firms that promise high returns while operating outside regulatory oversight. Zhongzhi alone managed 1 trillion yuan in assets according to its website, but reality painted a different picture. The company's admission letter revealed management had been cooking the books for years, creating phantom assets while funneling investor money into China's collapsing property market. When Country Garden's 1.4 trillion yuan debt crisis triggered a liquidity crunch, Zhongzhi's house of cards came tumbling down, and it won't be the last. Shadow banking exists because China's traditional banking system couldn't meet demand for credit, especially from property developers and local governments. While state-owned banks face strict lending quotas and capital requirements, shadow banks offered a backdoor, promising 8% returns to middle-class savers while channeling their money into high-risk real estate projects. This parallel financial system became the lifeblood of China's property boom, which accounts for more than half of global new home sales and represents the world's largest asset class at $62 trillion. When property prices soared, everyone won. Shadow banks collected fat fees, investors earned above-market returns, and developers built entire cities from scratch. But the model depended on one critical assumption: property prices would never fall. Wealth management products, UMPs, became the vehicle of choice. Short-term, off-balance sheet instruments that promised deposit-like safety with bond-like returns. By 2015, Chinese banks had issued 20 trillion yuan in UMPs, creating a massive maturity mismatch that would prove fatal when the property market turned. The seeds of today's crisis were planted during China's response to the 2008 global financial crisis. Beijing unleashed a 4 trillion yuan stimulus package, the largest in history relative to GDP, flooding the economy with cheap credit through state-owned banks. But there was a problem. Traditional banks couldn't absorb all the stimulus money while maintaining their deposit ratios, so they innovated, creating off-balance sheet vehicles that could issue deposit-like products without regulatory constraints. Shadow banking was born from this regulatory arbitrage, growing from a niche market to a $3 trillion behemoth in just over a decade. The People's Bank of China initially welcomed this innovation, viewing shadow banks as a way to channel savings toward productive investments while maintaining the fiction of controlled interest rates. Local governments, starved for infrastructure funding, became eager customers. Property developers, flush with easy money, built entire ghost cities across China's interior. By 2015, shadow banking assets had reached 16 trillion yuan, nearly 25% of China's GDP. The tail was wagging the dog, but Beijing was too addicted to the growth it provided to pull the plug. Subscribe and hit the notification bell. This story is developing faster than Beijing can contain it, and you won't want to miss what happens next. Today's shadow banking crisis threatens to unravel China's entire economic model. With property companies accounting for 40% of Chinese home sales already in default, the contagion is spreading through the financial system like wildfire. Evergrande's 2021 collapse was just the opening act. The world's most indebted developer, with 2.4 trillion yuan in liabilities, triggered a liquidity crisis that exposed the shadow banking sector's fatal flaw. When property prices fall, the entire system implodes. Now Country Garden, once considered financially sound with 1.4 trillion yuan in debt, is teetering on the edge. Its 3,121 projects span every Chinese province, a geographic footprint that makes Evergrande look contained by comparison. Chinese banks' non-performing loan ratios have already spiked to 4.4% from 1.9% in 2020, according to Moody's. But that's just the beginning. Local government financing vehicles, LGFV, hold an estimated 66 trillion yuan in debt, much of it tied to property revenues that are evaporating before their eyes. The shadow banking collapse will unfold in 3 devastating phases, each more destructive than the last. First, the trust company dominoes fall. Zhongzhi's bankruptcy filing signals the beginning of a sector-wide reckoning. Zhongrong International Trust has already missed payments on investment products, and dozens more will follow. Expect 2024 to see a wave of trust company failures as property-linked assets turn toxic. Next, the contagion spreads to traditional banks. Chinese lenders hold trillions in shadow banking exposures through complex off-balance sheet arrangements. As WMPs default and trust companies collapse, banks will face massive write-downs that could trigger a credit crunch. The dual-track financial system that powered China's growth will become its Achilles heel. Then the real economy implodes. With shadow banking providing 40 to 60% of China's credit, its collapse will starve businesses and local governments of funding. Property construction will grind to a halt, leaving millions of homebuyers with unfinished apartments and worthless contracts. The ripple effects will devastate everything from steel production to luxury goods, and that's when global markets will truly panic. Beijing's response reveals both desperation and cunning. Unlike the slow-motion collapse of Evergrande, authorities moved with lightning speed to contain Zhongzhi's bankruptcy. The court accepted the filing within weeks, a stark contrast to the years-long restructuring processes that typically plague Chinese corporate failures. This fast discovery and speedy resolution approach, mandated by President Xi Jinping in November 2023, aims to prevent panic by quickly quarantining toxic assets. But it's a double-edged sword. Rapid bankruptcies may contain immediate contagion while creating moral hazard for other shadow banks. Chinese regulators are also deploying selective bailouts through the back door. While publicly refusing state-funded rescues, Beijing is quietly arranging asset transfers and liquidity injections through state-owned enterprises. The goal is to maintain the illusion of market discipline while preventing systemic collapse. Meanwhile, new regulations are strangling the shadow banking sector. The 2018 Asset Management Business Regulations banned principal guarantees and imposed strict maturity matching requirements. But these rules may have arrived too late. The damage was already done, and the cleanup will take years to complete. The shadow banking crisis is reshaping China's relationships with global financial markets in unexpected ways. Foreign investors, once eager to tap China's growth story, are fleeing en masse as the true scale of financial system risks becomes apparent. International banks with exposure to Chinese shadow banking products face potential losses in the billions. European pension funds and sovereign wealth funds that invested in Chinese trust products are discovering their safe investments were anything but secure. The crisis is also accelerating China's financial decoupling from the West. As shadow banks collapse and capital controls tighten, the flow of international investment is reversing. This creates a vicious cycle. Less foreign capital means more reliance on domestic shadow banking, which is precisely the sector that's imploding. Regional allies are watching nervously as China's financial contagion threatens to spread. Hong Kong's banking sector, deeply integrated with mainland shadow banks, faces potential spillover effects. Singapore and other Asian financial centers are bracing for capital flight as Chinese investors seek safer havens for their wealth. The Belt and Road Initiative, heavily financed through shadow banking channels, now faces funding shortfalls that could strand infrastructure projects across dozens of countries. If shadow banking assets fall by just 30%, a conservative estimate, given property market declines, China faces a $900 billion hole in its financial system. Stress tests conducted by international banks suggest that a full shadow banking collapse could trigger a 15 to 20% contraction in Chinese GDP, dwarfing the impact of the 2008 global financial crisis. The IMF's estimates of 66 trillion yuan in local government debt become particularly ominous when combined with shadow banking losses. Monte Carlo simulations run by risk management firms show a 40% probability of systemic banking crisis within 24 months if current trends continue. The models account for feedback loops between property prices, shadow banking solvency, and credit availability, creating a downward spiral that becomes self-reinforcing. Even optimistic scenarios project 5 to 7 years for full shadow banking sector recovery, assuming aggressive government intervention and no external shocks. Pessimistic models suggest permanent structural damage to China's financial system, with shadow banking shrinking to a fraction of its peak size. The human cost could be staggering. Up to 50 million Chinese households hold shadow banking products, with total exposure estimated at 200 billion yuan. When these products default, it will wipe out the savings of China's emerging middle class, the very demographic that powered the country's economic miracle.